Welcome to Theo Trade. This is Don Kaufman. It's May 6, 2019, and you are watching the Theo Trade evening video. 8 minutes to go to the closing bell. Spoos, that is the S&P futures, are down 11. Listen, the marketplace effectively shrugs off all risks. Let me just highlight this for a moment, because one of the things that's I think the real standout here happens to be simply the range that we've traded from the overnight session to effectively, well, right now, because we're pretty much sitting near session highs. You start looking at this and you're like, wow, that's a 60-point S&P range. Yeah, it's a 60-point S&P range. You take a look at the volume, okay? We're maybe going to do 2 million contracts by the close today. Maybe do 2 million contracts on a 60-point range inside of the S&P futures, okay, seems inordinately light, right? My take on here, a little bit of short covering. A couple of shorts came in, okay, covered themselves. We came up to the 29.11, a few dip buyers after that, and we were off to the races. I mean, as I was saying a moment ago, that the market's just effectively shrugging off all risk. Now, of course, by this time, everybody's heard about the tweet that came out from the administration, okay, taking a, if you will, shot across the bow to kick off another round of tariffs, trade war, okay. I think, really have to view this as effectively round one. The Chinese trade war discussion, especially for this week, is far from over. Either number one, the Chinese are going to retaliate with their own tariffs, okay? Or number two, again, we're just going to have further discussion and put these tariffs in place, okay, later this week, specifically on Friday. I think actually the Chinese will probably take the next shot specifically at the U.S. And why do we believe that? Well, it's probably why Apple, okay, took the kind of the brunt of the hit in terms of technology today, given the fact that they might be vulnerable to the Chinese trade war. In terms of tech, it's interesting how this actually played out, because you'll see Apple, which has exposure to China, taking the brunt of the hit. The market, though, is fairly smart. What did it do? Well, we rallied up Google. Why? Because there's no Chinese exposure. You know, it's funny how a week changes effectively everything. The week prior, nobody wanted to touch Google like a disease because revenue was down. All of a sudden, we talk about Chinese trade war. Google's looking pretty sweet comparison to anybody that has exposure to China. But that's not the only risks that really pertain to this marketplace. Something else that I want to mention here that I think a lot of people kind of missed. The semi-annual Federal Reserve financial stability report, you're looking at it right now, it came out. There's elevated valuation pressures, okay? And please just Google this if you really want to read like all 60 pages of it, okay? It's not exciting reading. Nevertheless, one of the things that I have to sit back and be a little shocked at as a trader is I've seen this report come out and really rock markets, especially when this report says elevated valuation pressures are signaled by asset prices that are high relative to economic fundamentals or historical norms. Yeah, basically what they're saying is we think, this is the Federal Reserve, we think quantitative easing may have had a little bit of an issue. Number two over here, excessive borrowing by business and households. Really? We had no idea. Yeah, we're being a little facetious on this particular front because borrowing is effectively out of control. Then we come to number three, excessive leverage within the financial sector. Oh, that's a shocker over there. The financial sector, okay, at what? Excessive leverage. It's because the volatility is effectively nil. When volatility is low, what does the financial sector do? We borrow more. Why do we borrow more? To make less. We have to borrow more to make less, to amplify what we're making, which is less. Last but not least, there's actually some funding risks. Now, that's a little bit convoluted to expose the financial system to possibility that investors will run. Okay, they're talking about run of the banks by withdrawing their funds from a particular institution. This is, again, this is a report that comes out semi-annually and just highlights risks. So don't look at this as me like digging in, trying to find risk over here. I'm telling you this report is trying to find risks. But given the fact that the four major factors that were investigated and researched on this particular front during the semi-annual report are quite dire, especially when, again, the Fed recognizes valuation being a little out of control, and yet here's our S&Ps right now with just moments to go to the close that are only down 14 after, again, in the overnight session, we were down pretty much as what, 28.83, 60 points. What's 60 points amongst friends? Again, I would anticipate the remainder of this week that we're likely to see some increased pressure, some increased risks. One of the real standouts to me, in a marketplace like this, forget about looking at individual stocks. I'm going to say that again. Forget about looking at individual stocks. Yeah, I brought up Apple, a little tongue-in-cheek. I brought up Google a moment ago. Ooh, we can even look at Tesla, but still my heart. Doesn't matter that much. Okay, what matters in a marketplace like this, okay, is when you start looking at the S&P 100, markets are going to be much more heavily correlated. I mean, today we saw 99 products this morning down. Didn't matter who you are, where you are. Effectively, if you were in a marketplace, you were going to be down. The advanced decline line picked up. Okay, but minimally so. Now, one of the things that really stood out, and it's just simply striking to me. I mean, that's what I try to do on these kind of nightly videos, is point out things that you would not ordinarily see. The differential between the May and the June volatility futures, okay, is striking. It's almost like this trade is being suppressed. Now, what we know about this is the single largest short position in the history, okay, of this product being the volatility futures. The single largest short position ever recorded was only about 10 days ago. Okay, so they said that everybody, okay, and their family is short volatility futures on the professional side, of course. And yet the volatility futures had very little reaction to today's announcement, even in the overnight trade. What you expect in something like this is that the May volatility future would take off to the upside, the June volatility future, okay, would remain, take off to the upside, but not nearly as much. And what happens is, okay, the differential between the two starts to what? Converge. So in many cases, when risk really hits the fan, that's kind of what I call it. When the risk hits the fan, the May can even eclipse the June. And what we term, people talk about backwardation and contango, just call it inverted volatility futures, where the May volatility futures spike above the June volatility futures. The thing that's striking, we didn't even get close to that today. The closest we got was within 55 cents. Now we've widened back out to 90 cents differential. And there's a question mark behind it, because it's like this marketplace goes, risk? I laugh at risk. I'm telling you right now, with the largest short position in the history of the marketplace, I wouldn't laugh at risk if I were you. You're sitting, okay, on a time bomb when it comes to these volatility futures, and they're just not reacting. The other aspect that really I think is kind of striking is even the bonds. Even the bonds, they rallied a little bit in the overnight, and they actually did what? Okay, they cooled off throughout the day. Okay, nothing seems to stand in the way of this marketplace right now. Not the Federal Reserve last week, the Fed comes out last week, says transient. Market actually sells off for less than 24 hours, rallies back. Okay. All of a sudden, we're kicking off another trade war, which is huge economically. Let's just put it on the table over there. It's huge. It has economic implications for GDP through and through. What happens? We rally back up. Okay? The financial stability report comes out, tells you that valuations, according to the Fed, are lofty. What does the marketplace do? Unimpeded. Absolutely unimpeded. The bonds are unimpeded. Okay, the S&Ps are unimpeded. The volatility, it literally feels, okay, like a suppression type trade. There is a little bit, there is the closing bell, a little bit of movement on the volatility front. Okay, on that volatility front, what do we actually have? The VVIX took off to the upside. It contracted a bit, but this is something we'll continue to watch throughout the course of the week. Again, what I would consider throughout the course of this week, first of all, cruise into the SPX. The SPX today already clipped to the outside of its expected move and pulled well back inside of it. The downside of the expected move happens to actually correlate to a gravity point, which is 29.11. Nevertheless, if you take a look at the SPX, we did have a little bit of expansion of risk in the SPX expected move. We're up to $40. So between now and the remainder of the week, we still have, okay, a fairly considerable volatility in front of us. I mean, considerable in comparison to what we've seen lately. Nevertheless, on a broader note, 15% volatility after everything that we saw today. And I want you to think about this for a second. After everything that we saw today, there's a 15% volatility, which is, again, a few percentage points above. You're 30, 40% higher volatility than you were last week, right? Okay. But $40 expected move. And if you hear, a question mark in there, why do I care? It's a $40 expected move. I don't know. Today, we had a 60-point range. A 60-point range with only a $40 expected move for the remainder of the 4 days. Net, the volatility didn't take off to the upside, even though we stood here, okay, and stared down the face of risk. It's a lot to think about. Again, I myself would expect considerable volatility through the remainder of the week. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.